Well, when I need to talk about what is going on in Japan, the Japanese investor, perhaps the yen carry trade, the person I go to who has spent the most time in Japan and traditionally works with Japanese investors is the one and only Jonathan Twomley. How you doing, sir?
I'm doing great, Michael, and it's fun to get to talk about Japan because, it doesn't really happen that much on a real estate podcast, but let's go for it.
Yeah, so we're going to talk about that first, but we're also going to talk about the recession, the great discussed recession. Maybe it's not coming. We'll talk about the chances of no rate cut in September, which I think might surprise folks. We'll talk about the broken Sahm rule. Yes, Claudia Sahm is out saying it's broken. And finally, we'll close with Mr. John Burns. But a lot consternation about the stock market starting last Friday. Then on Sunday, I believe the Japanese Nikkei lost like 12 or 16% or something crazy, which caused our market to go down Monday. A lot of people said it was because the Bank of Japan surprised the market and raised rates, which pricked the yen carry trade. Just curious what your Japanese investors were saying or discussing over the weekend, because I'm sure it was interesting.
Yeah, so unfortunately, I haven't actually had a chance to talk with any Japanese investors since then, although I'm meeting my biggest investor for dinner on Saturday. He's going to be here in New York, which is nice. Haven't seen him in a long time. But I do know sort of generally what people are chattering about. And I think we should talk about what the yen carry trade is exactly. And because it has been a big thing for Japanese investors. Now, for what the yen carry trade means basically is borrowing in yen and then deploying overseas, right? And the
Correct.
reason that
Mhm.
this works and even has worked for, you know, everyday people, like there was for a long time, there was a big thing about like this was being driven by housewives in Japan, right? There was a while where like crypto investment was being driven by housewives in Japan. And same thing has happened with the yen carry trade. It is obviously a phenomenon that bigger investors take advantage of, but it's kind of all across the board. You see this. So basically, because interest rates have been so low in Japan, uh, what people have done for a long time is uh, borrow borrow in yen and invest in dollars, where pretty much, or not even dollars. This goes on in Europe as well. But basically, any place that pays higher interest rates than Japan allows you to make money on this trade. Now, the risk is that the yen currency rate changes so that now you're upside down on the trade, right? So when the yen was, you know, I I, I think I got to think about this a little bit because, it works best obviously when the yen is strong versus other currencies. So you have a lot more, you know, you invest first when the yen is strong, and then when the yen weakens,
Yep.
right?
There's a lot more juice when the yen starts strong. Yep.
Yeah, exactly. So so that's been happening. The yen has been slowly deteriorating in value against other currencies for the last couple of years,
Mhm.
driven by interest rates being higher here. And again, and that like those interest rates are driving this yen carry trade is sort of what's driving the collapse of the yen, right? Because people are selling yen to buy dollars, right,
Correct.
or to buy euros, right? And so that's been exacerbating the currency issue, right? So kind of has this like vicious cycle impact to it where the yen starts to decline a little bit and people see it and they're like, oh, I want to get in on the yen carry trades. Then they start selling yen, buying dollars, and it makes it even worse. And for the
Mhm.
people who are in early on the trade, it works really great because let's say, you invest, if you can do this, just as an example, probably what they're buying is treasuries, right? But even if you just to make it really simple, let's just say you had the ability to put your money in a US bank and get 5%, right? It, if you're getting 5% on your money, which is like 5 times more than you're getting in Japan, and then it all goes up by 20% because of the currency fluctuation, like you're doing really well. So
Yeah.
this was driving this. Now, what happened was the Bank of Japan has been increasingly concerned about the collapsing yen because it's sparking inflation in Japan because everything costs more. And they import, we think of Japan as a great exporter, but it's really exporting manufactured goods and not even so much anymore because it manufactures so much of the stuff in China, right? So it's not directly
Mm.
exporting it. But still, it's a great like export led economy, but they import a lot of stuff, right? they have to import all their natural resources. They have to import all their oil. They have to import a lot of foodstuffs. So that all of those inputs, have um, it's causing inflation in Japan, which, ironically enough, the BOJ has been trying to generate inflation in Japan for a long time, right? Now
Mhm.
that they got it, they freaked. I think they didn't freak out at first. I thought they were like, oh, this is great. We'll just keep this is what we wanted all along.
Mhm.
But it's now gotten to the point where people are starting to grumble about it. So the Bank of Japan tried to intervene in the markets by buying yen. That was basically throwing money away. It didn't work. They wasted billions of dollars on trying to support the market, and that those billions just evaporated. And they finally broke down and had to raise rates by a quarter point, which has not happened
I think it
in
was a
like what,
tenth of a point. I
a
think
tenth of a
it
point.
was,
Yeah,
yeah, it
it
was
was
like
crazy.
tiny. Yeah,
Yeah.
crazy.
But the problem was it wasn't, sometimes it's not the magnitude that matters, it's just the fact that it happens, right?
Yep.
So the BOJ had not raised rates in like what, 20 years at least,
At
right?
least.
At
Yep.
least maybe 30. And so the
Hmm.
fact that they raised rates by this tiny bit made people freak out and start
Yeah.
unwinding these trades, right? And then that also a lot of what happened in the stock market was actually foreigners selling their their positions, right?
Hmm.
So the and that caused this crash. So so the freak out happened because the BOJ
Yeah.
changed rates a
Surprise.
little bit.
The BOJ surprised the market.
Yeah,
And the other, so I really like that kind of explanation. For me, it's really simple, right? You're playing with a spread, and then you're playing with currency devaluation. And you're right. When the yen starts strong and it has a 5-year track record of getting weaker, it's a great trade. The other thing about currencies that wasn't discussed there is it's a highly leveraged market.
yeah,
You can get massive leverage. I'm not talking 50% leverage. I'm talking 95% leverage. There's a huge amount of leverage in the currency market. So the delta, the surprise move collapsed the spread a little, but it made the Japanese yen stronger. And then, oh, by the way, you got people like Jeremy Siegel saying, hey, let's cut the US rate 75 basis points. That would have reduced the spread, weakened the dollar significantly. And this thing could have just
yeah,
blown up if something like that would have happened.
yeah, exactly. It could have just caused the Japanese stock market to really, I mean, it had a correction, but it could have caused it to collapse, right? And by the way, because of the other thing that was going on here, and probably a lot of Americans were not paying attention, the Nikkei was at an all-time high. It had
It
taken
was
30
30
years
years to get there. Yeah.
to get to a new high, but it did. But this was largely driven by foreign investors taking advantage of the cheap yen to buy what looked like bargain stocks in the Japanese
Yeah.
stock market, right? Because, everything was on sale from a US, perspective, right? So a lot of investment was going into Japan at the same time, driving up the stock market. So as soon as anything sort of changed, if Americans or foreign investors suddenly thought, oh, the BOJ is going to raise rates, that's going to cause the yen to strengthen against the dollar, like they had to pull out fast, right? To get, to
Yeah.
not, because these trades
Yeah,
were,
they had to cover their. I really think there was some hedge funds or somebody blew up because
yeah,
there was just indiscriminate selling, and people were raising cash to probably pay off margin calls. It
yeah,
was pretty bad.
yeah.
So the other thing about this kind of last story, and we'll go to our other topics, is the Bank of Japan came out yesterday and basically said, "Whoops, our bad. We won't do that again. We won't surprise the market." And seemingly, at least within 24 hours, seems things seem to be calming down.
Well, not only calming down, the day after this crash, the Japanese stock market had its best day in history.
Ever. Yeah.
As as they basically, all the stocks are rebounded. I don't think they rebounded all the way, but they rebounded so much that it was the best one day,
Wow.
in
That's
the
crazy.
Japanese stock market in history. So, uh, and like we saw here too, I mean, everybody was freaking out about the stock market. I mean, calling it a crash, it turned out at the end of the day to be about a 2.5% move, which is really like, and it happens all the time, right?
Right.
And,
Yeah.
it would have to be 10 times as large to be considered a correction.
Hmm.
So there was just a lot of freaking out by I think people who wanted to freak out because for whatever reason they're rooting for a recession. It could be politics, it could
Mm.
be wanting
There
interest rates to
there have been
drop.
a lot
Yeah.
of people calling for a bear market recession, myself included. You could throw me in that. I think one started June or July. More on that later. But yeah, I think at least at this point, Thursday morning, things seem to be kind of back to normal, if you will. Let's go to John Burns, somebody that I follow, somebody you follow. John Burns put out some notes here in the last 24 hours that you've read, and let's talk about that.
So so a lot of what we saw happening with the treasuries being bid up and interest rates coming down very rapidly was based on the last unemployment report and jobs
Mhm.
report, right?
Yep,
And
Friday. Yep.
so unemployment ticked up to 4.3%. New jobs missed, and everybody started invoking the Sahm rule, which
Hmm.
is, if unemployment goes up by, what is it, half a point from
Half
the
a
trough,
percent. Yeah.
yeah,
Yep.
half a percent from the trough, then you're in a recession. So
Hmm.
people who have been, in my mind, sort of predisposed to wanting interest rates to go down jumped on this as a like, oh, the recession's coming, oh, interest rates have to go down, right, et cetera, et cetera. Now, John Burns came out in the middle of all this and said, hey, and if you don't know who John Burns is, I mean, he's a really, really well-respected
Oh,
housing
very.
analyst,
Yeah.
probably, the biggest and best
Got
out
to be
there.
the top one or two,
Yeah.
no doubt. Yeah.
And so he said, hey, wait, folks, the unemployment figures were probably skewed a bit by this hurricane in Texas, where a lot of people were temporarily laid off. It counts as unemployment, even though they're basically just furloughed for a couple of weeks. And also, the unemployment rate went up because, well, we've got record labor participation. So like the denominator is bigger, right? So it
Hmm.
doesn't mean that there's fewer people working. In fact, we know that there are more people working because 100,000 jobs were filled, but
Right.
but the unemployment rate rose potentially because the number of people looking for work, like more and more people were pulled off the sidelines
Correct.
looking for work. So that caused the rate to rise. So it didn't really get noticed, but he threw in that note of caution about what's potentially really going on. And, you know, you've got people, like you said, Jeremy Siegel saying, oh my God, the sky is falling, 75 basis points cuts in September and another one in December. Let's go, And so John Burns was putting a little bit of like, kind of tempering the
Here.
fever a
Yeah.
little bit there.
Yeah.
Yeah. Yeah.
Yeah. Yeah, I love John Burns. He's been putting out real estate data for a better part of a couple of decades. Been lucky enough to interview a couple of his guys on my show over the years. So always puts out a lot of great stuff. And you really do got to pay attention to that Texas hurricane because again, there was a lot of, I think the number's dirty because again, there was a lot of people furloughed and, just a follow through this morning the weekly unemployment claims come in. And if you don't remember, last week was 250,000, which was a cycle high, which was like, it showed a step function up from
Mhm.
230. Well, fast forward a week, the number that came out today was 233, right? So we're kind of like right back to where we were the
Right
last three or
before that.
four months. Now we got to wait another week with the weekly data. It too can be noisy. Um, but again, there's a lot of folks out there that I think you're right, myself included, have been calling for a recession. And maybe we're watching the boogeyman and, every shadow is that boogeyman as opposed to, hey, it's just a shadow, stop losing your mind. So love John Burns for that. Let's talk about Claudia Sahm. I
Well,
don't know
just
if
before we
people,
get into that,
Mhm.
I just want to talk about like dirty data a little bit because,
Sure.
one of the things that I see commented on social media a lot is like this kind of like conspiratorial, like thing like, oh, the BLS is going to go back and revise that data anyway, and they're going to show the truth when they revise it, and like they're fudging the numbers. And that's just, if people have a conspiratorial mindset, like that's what they're going to think. But the BLS is constantly going back and revising the numbers because the data improves over time, right? They're making their sort of best educated guess, quickly, and then as they get more data, they go back and revise. So they're always revising. They revise every single time, right? And so this isn't a conspiracy. This is actually intellectual honesty. And, so people who have this kind of like government is essentially a giant conspiracy mindset,
Mm,
will always point at this and say, well, look, wait till the real numbers come out and you'll see but those numbers go up and they also go down, right? That
yeah.
sometimes they
Well,
go back
yeah.
and
So
revise and it looks
yeah.
better. It looks much, and it turns out that things were actually better than they originally said. And it's, the only way you could say this is a conspiracy is if it always looked worse
Mm.
every revision. But then you have to ask the question, well, why would they, if they were making it up, why would they then go and correct themselves later, right? Like they would
Well,
just fudge the numbers all along, right? They just, what would ever be the reason to go back and say, whoops, we made a mistake,
yeah.
and here are the real numbers. So I just
Yeah.
find this whole thing sort of funny.
Yeah,
you
so
know
I mean, let's talk about that. So again, I actually met some of these people decades ago at Bureau because again, I'm an economist. I've studied this. I've sold stuff inside the federal government. So I've actually talked to some of these economists. This is probably a decade ago or so, and they're the classic, pocket protector, data number. They have their models. They want to get it right. These are PhDs that take their job very, very seriously. So again, it could have changed in a decade, but I don't see any kind of fudging. They want to be right, right? Because their reputation's on these numbers. So that's that.
Yeah, I mean,
The other
my
thing,
I was gonna say my downstairs neighbor works for the New York Fed. He's an economist for the New York Fed. So, like I talk with him once in a while about it, and he is like the epitome of the guy who wants to get the data right.
oh yeah, yeah,
Yeah, I mean, it's
it's
just like
exactly
not,
who they are.
yeah, yeah.
They don't, yeah. And again, so that's that. The other thing you got to realize, and again, I understand this as an economist, the data that they're putting out there gets most noisy, aka revisions at cycle changes.
Hmm.
And that's either an expansion or a contraction. And what we have at least seen over the last 8 or 10 months is a pretty consistent revision down in most numbers. Something like 7 out of 10 or 8 out of 10 of the reports have been revised down. Now, again, you could look at that and say conspiracy. What I look at it and go, oh, cycle change. Because
Hmm.
again, the models that they've been operating with in a upcycle are 5, 6, 7 years in the making. They don't catch the rollover until it's on the other side. That's just how data works. So when I look at all the revisions, I go, well, cycle changing, and they're missing it. So those are things that I look at. So yeah,
Well, yeah,
I
and
don't
so
think
you're
they're
looking at,
purposely being bad.
yeah, and anyway, you're not, it's the data is noisy, right? But it's the
Yeah,
trend that matters, right?
especially
So it's,
correct.
yeah, individual data points don't tell you much.
Correct.
But people get very excited about the individual data part. And I think sort of sliding into the SAM rule now, which I know is next, like I think the
Mhm.
reason why people were very attracted to the SAM rule is because it's saying explicitly like we're looking at the trend. We're not looking at the data point.
Correct.
And
Correct.
so, but we're trying to to come up with a model that works on a shorter time frame than
And yep, an
that
early
shows a trend
indicator.
on a shorter time frame, but is still an accurate predictor. And so I think
Yeah.
that's why the SAM rule has kind of
Yeah.
suddenly become part of the zeitgeist. And but let's talk about the SAM rule.
Yeah. So
What is it?
Claudia Sahm,
Yeah.
who's the creator of the Sahm rule. And again, I think the other thing that's really attractive about the Sahm rule is it's been right historically, 8 for 8.
Right. Right.
So it's right. It looks at rate of change, and it's relatively quick because it just needs 90 days of data, right?
Yeah.
It's kind of that elegant solution. One of the things people need to realize if you're not following Claudia Salm on Twitter or X, she is screaming that her model's broken. So I spent some time going through her
Yeah.
analysis.
Explain this to me. Explain this to me. What it means what she's talking about.
So when you look at unemployment and the Salm rule, it's all about the rate of change of demand, right? People need, like, I'm needing jobs, right? And when the unemployment rate spikes, at least over the last 8 times, it has been all demand deterioration, jobs disappearing, people getting laid off.
Hmm.
And what Claudia Salm is saying is, unfortunately, this time is different because it's not the rise in or the cutting of demand. It's been, hey guys, we have all of this new supply, aka immigration.
Hmm.
So if you add in all this immigration, aka participation, and you change the denominator, that can cause the Sahm rule to spike. So in her estimation, I read this morning, about 50% of the move, and right now the Sahm rule has been triggered, it's at 0.53, but she is saying, guys, don't, it's not right. 50% of that move is because of supply changes, not demand. The Sahm rule has zero input on supply. It's a demand, it's a rate of change on demand. And she's looking at this data going, my rule doesn't apply. That's what she's saying.
Wow, that's interesting. It's also interesting that, I mean, I have been hearing about this spike in immigration. It's interesting on a whole bunch of different levels. I mean, it's interesting that there is so much labor demand in the economy right now that we can have that much immigration and it doesn't cause unemployment to rise. I mean, it causes
Clearly is.
it causes quote unquote unemployment to rise because the labor participation rate is
Mhm.
is higher, but it hasn't actually caused jobs to be lost. Like people are not
No,
losing
more
jobs.
jobs are more people are
Yeah,
employed. 100 and
yeah,
whatever it was, 18,000 or whatever last month.
yeah.
So,
They're not job people being displaced by immigration is what I'm trying
yep.
to say, right? So
No,
it's
absolutely.
there's just they keep on
It's also
coming and
probably
they keep on
helping
employing them.
inflation. It's helping
Yeah,
inflation.
yeah,
It's crazy.
absolutely.
All right.
Yeah. So,
All right. Let's talk about
all
a
right.
recession next. Jamie Dimon, right? The person, Jamie Dimon, obviously JP Morgan, fame. He said we were facing an economic hurricane 2 years ago, 2022. He said this. Obviously, at least to now, one hasn't come. He's now out saying he still sees a recession coming. We are not in one, and the chances are about 35%. So just curious how that lands, how you feel about that.
Yeah, I just remain skeptical about a recession in the short term because, as you and I have discussed before, unemployment, however you slice and dice it, is still below what's traditionally considered full employment, right?
Correct?
Inflation is still above the 2% that the Fed says it wants to get to, right? This
Correct?
immigration data point is another one. If we've had that much immigration and it has not caused unemployment to rise, then clearly the economy is humming. We're still having jobs created. And I think what people are talking about now is like, well, they're seeing certain trends. The consumer is getting a little stretched. The new jobs created are lower than they were before. I mean, this could potentially indicate a recession on the horizon,
Mhm.
but if it comes and how big it is when it comes are just factors that, I mean, we just can't really predict right now. But I don't think that we're currently in a recession.
Yeah.
I think we're in one of those situations where, you know, it doesn't feel great because prices have gone up by 20% or whatever in the last 2, 3 years, and people do feel stretched, right? That doesn't feel good, but that doesn't mean that we're actually in a recession, right? Because people are not losing jobs, and consumer spending is not down, right? So we can sort of argue about the semantics of a recession for sure, but is the economy bad? It doesn't seem to be. I mean,
Mm,
here's a data point. Our hotel is doing just as well this year as last year, right?
mm.
So, and at higher room rates. So, if that's
There you
one
go.
single data point, but I mean, that if we were in a recession, we would be worried about the opposite happening. So,
Yeah.
um, you know,
Well, let's get to the big question of the day. I mean, if you were to look at the Fed watch tools, if you will look at mainstream media, even, business media, it's a foregone conclusion that we will have at least a 25 basis point cut in September. And the money odds as of this morning are we are going to have a 50 basis point cut. I actually want to step back and ask you, what are the chances we have zero rate cuts and they push any rate cut decisions off until November? What do you think?
I'd say that there is at least a 25% chance of no rate cut at all.
That, yeah, it's
Yeah.
really funny because again, and my audience knows I've been that one guy going, no rate cut September. We're going to November and it's going to be 50 because they're going to be late. Um, yeah, I would, you know, we do have a lot of data coming. We got CPI and PPI next week. We have one more employment print. We will also get CPI, PPI before the next Fed meeting in September. We'll also get PCE at the end of this month. So we've got, what is that, 2, 4, 5, 6 real important economic data. So all of this could change. But I agree with you. It's a non-zero
Yeah.
percent chance that there's no rate cut in September. It could be as high as 25% for sure.
Yeah, I just don't see this as a foregone conclusion. And I think that the market's enthusiasm for a rate cut has as much to do with them wanting a rate cut as it has to do with there actually being a
You
rate
know what?
cut
You know what
in the
really is?
cards.
You know what's really funny to me in this rate cut decision? All I can keep thinking about is be careful what you wish for,
Oh yeah. It's,
right?
I mean, I did a long post. I don't know if you saw it on LinkedIn the other day.
Missed it.
Got a lot of attention where I basically said, so recently in the close the barn door after the horse gets out category, there's been a lot of people posting on LinkedIn about like, you know, what you should look for in a sponsor, how you tell a sponsor is, nobody's posting
Mm.
this at the top of the market when everybody is, you know, is minting money with multifamily, but suddenly, people get burned and now everyone's like, oh, here's how you evaluate a sponsor, So, as if they've been saying this all along. Right. And so I said, look, all these things that people say are true. I mean, you should look at their track record and do they have skin in the game, you know, et cetera, et cetera. What's the deal structure look like, et cetera. However, all of those things may really be irrelevant because, they've got skin in the game. Maybe their rich daddy gave them the money, right? Their track record, well, if they invested at the right time, sure, they had a great track record, means nothing, right? So, are they open with their past failures? Well, who knows? Even if they disclose some, have they disclosed them all? You'll never
Mhm.
know, right? So, but here's one thing that will, I guarantee, tell you more about the sponsor than any of those things: their attitude towards rate cuts. If they are out
Mm.
there posting about rate cuts, like giddy and excited about rate cuts, it just shows that they're not that sophisticated. They haven't been in this game that
I
long.
love that.
Because if
That's a
they
good point.
think that rate cuts are going to save the day or rate cuts are going to cause a rally in real estate, they just haven't been around long enough to know that
Correct.
that's not true. Because if you look at, first of all, the big reason for it falls into what you're just talking about, the get what you wish for category. Well, generally speaking, rate cuts happen when the economy is soft, and that is not good for multifamily, right? Because before the last run up, and most of these people have not been around long enough to know this, before the big run up and where it was all about low cap rates and low interest rates, the mantra, if you were a real estate investor, was jobs, jobs, and more jobs. That was the number one thing you cared about. Jobs, 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 jobs. Why? Because only people with jobs can pay rent, right?
Hmm.
And if you've got rate cuts, it's usually because jobs are going in the wrong direction, and that's not good for you if you're in multifamily, right? So, and that, as much as low interest rates can help the price of multifamily, it won't help the price of real estate if the other things are not also in place, right? So it does not matter if rates go to zero if the economy is in the crapper, right?
Exactly.
Because banks are not lending, right?
Yep.
People are not paying rent.
Yep.
Vacancy is going up. And who
Hmm.
cares what rates are? Rates will not help you if those other things are not happening. The reason that low rates had such a big impact on real estate in the last cycle was because the economy was strong for such a long time,
Yep.
and we had this Goldilocks period where low rates did not cause inflation, right?
Hmm.
Where low rate, so employment was steady for a long time, the economy was steady for a very long time, and we had low rates. It was a Goldilocks environment, and that's why cap rates sunk so low, because the perceived risk went to practically zero on multifamily.
Yep.
Usually
I love that.
rates, usually rates reflect something else, right? So low rates reflect softness of the economy, which is bad for multifamily. The other thing I want to say is that if people think that low rates are going to cause a bull run in real estate the way that it could potentially do in the stock market, well, all they have to do is look at the Great Recession and see what
Hmm.
happened after that. Rates went to practically zero, right? And cap rates did not follow for years because there was this big overhang of foreclosures that the
It
market
was
had to work
so
through,
painful. Yeah. It's
right?
painful.
And this is going to happen again. Now, I know there's a lot of operators out there who, on the margins, because they have floating rate debt, rate cuts may save their asses, right? But probably won't save most of their asses. Even 75 basis points not going to save their asses because mortgage rates There's still a lot more. The mortgage rate is composed of a number of things, right? There's the treasury rate, and then there's the bank spread. And if the banks are perceiving more risk, that spread's going to be bigger. So you're not going to get, it's not going to just follow through into cheaper rates, right? So there'll be less of an impact there, right? Banks, if they're skittish, they just won't be lending. It doesn't matter what the interest rate is, right? The Fannie and Freddie just came out and said they're tightening lending standards, right? So, you know, we're going to be seeing a similar situation to after the great financial crisis, where you could see both cap rate expansion and rates going down, right? And it's a great environment to invest in if you can get a deal and you can get the debt, right? But those two things are going to be more difficult. So
yeah, couldn't agree more.
So if people who are just saying rate cuts, they're just not sophisticated enough to understand.
Yeah, you've got to really start to understand some of these cheerleaders. Some of these people got lucky on timing, and they think lower rates are going to save them. They're just not. They haven't been in the game long enough, and they got to be careful what they wish for. Jonathan, you do a lot of work on LinkedIn. Is that where people should follow you?
Yeah, these days that's the best place to follow me. You can join my community. Talk with me, follow my stuff. DM me, whatever, just come on LinkedIn and send me a connection request. Happy to accept it.
There you go. Let him know you came from ORAT, or One Rental at a Time, so he accepts it. Thanks, buddy. Take care.